So this is partnership problem 1. We got 3 partners or 3 individuals, acai, blackcurrant, and cloudberry. They form a general partnership, so that's going to be extremely important because they're forming a partnership, and they contribute the following pieces of property in exchange for 1/3 interest in the partnership. So we can just call these A, B, and C. So A contributes land, which is a capital asset that A acquired several years ago, worth $100, and A has a basis in the land of $40. B contributes machinery with a basis of $25 and a value of $60, and also contributes $40 in cash. B purchased the machinery several years ago for $75 and has taken $50 of depreciation. C contributes stock with a value of $100, in which C has a basis of $160. C purchased the stock 3 years ago. So what are the tax consequences on these events to the partners and the partnership? All right. Whenever you're dealing with business entity taxation, here partnership, which remember partnerships are taxed specifically under the tax law a certain way, you got to look at where exactly the life cycle, where are we in terms of the business? We're dealing with a formation question. This is a formation. And we have contribution of property in exchange for partnership interests. So we have to consider the consequences to the partners and the partnership. Now, the first rule to note, remember that partnership taxation, the rules for partnership taxation are found in subchapter K, which is the 700s of the Internal Revenue Code. So section 721 is a non-recognition rule. Just like you have like-kind exchange non-recognition rules, involuntary conversion, we have a non-recognition rule for partnership and partners. So this applies to both the partnership and the partners. When there is an exchange of property by the partners in exchange for a partnership interest, no gain or loss shall be recognized. So it's a mandatory rule. So no gain or loss recognized. Now, remember that in general under the tax law, we've got realized gain and loss, right? Section 1001, amount realized minus adjusted basis gives us our realized gain or loss. Well, here, all 3 of these individuals, A, B, and C, are exchanging property, right? We've got land by A, we've got machinery and cash by B, and we have stock by C. So all of them are giving up property to the partnership in exchange for a partnership interest, right? 1/3 partnership interest. So those are pieces of property, and they're getting partnership interest, so no gain or loss recognized. In terms of realized gain or loss calculation, their amount realized is going to be the value of their partnership interest minus the adjusted basis of the property they're giving up, right? All these pieces of property, that would be a realized gain or loss. But again, it's not going to be recognized because of the non-recognition rule. So therefore, all parties in this problem are going to have no gain or loss recognized. There's no services being contributed by the partners, and that's the distinction in the tax law, property versus services. There's also no liabilities to worry about. Now, we'll see a problem later on where we look at the effect of liabilities, but there's no liabilities. So there's no gain or loss to all the parties. Now, the other issue, as we know, non-recognition rules, all of them have a corresponding basis rule. So for the partners, which we label the outside basis, the outside adjusted basis in your partnership interests, this is going to be carryover. We're going to carry over the adjusted basis of the sum of all pieces of property that you've contributed. For the partnership, we take an inside basis in the assets that the partnership receives equal again to the carryover basis of each individual asset. Now we call the partnership's basis the inside basis because it's within the partnership. All the assets are owned within the partnership. The partner's basis is called the outside basis because it's outside the partnership. Again, we carry over as well. So it's both a carryover basis principle. All right, so we need to go through and determine the adjusted basis of each asset to the partnership, also each asset or each partnership interest to the partners. So let's start with the partnership. The best way to do the partnership is just to do a balance sheet. You have assets, liabilities, and capital. So within the assets, we're going to have two columns. We're going to have our tax column, which is also known as our adjusted basis column, and then we're going to have our book column, our book value. Because in partnership tax law, it's really important to focus on capital accounts and book value of assets. So we have four assets here. We've got land, machinery, cash, and stock. Let's just put them by order of liquidity: cash, stock, and then land and machinery. Depends on how you learned it. I'm just going to do land, machinery like that. And again, the rule is the basis in each of these, the inside basis, because again, it's inside the partnership, it carries over. So the cash basis is always just going to be the face value, which here is 40. Stock, 160. So again, we're just carrying over the basis of each item that's given to us in the problem. The land has a basis of 40, my apologies. And the machinery has a basis of 25. The book value, of course, is going to be the fair market value at the date of contribution. So cash 40, stock 100, land 100, machinery is going to be 60. Now notice each owner is getting a 1/3 interest. Each of them is giving up $100 worth of stuff, right? A is giving up land worth $100, B is giving up machinery and cash together worth $100, and C is giving up stock worth $100. So we add all these up and we get $300. The liabilities, there's no liabilities here. Capital. We've got A, B, and C. Just like for the assets, we're going to have a tax column and we're going to have a book column. All right. So the book value of the capital accounts, to get that we take the net worth of the business, right? The capital account, you all know how to calculate that. Assets minus liabilities equal capital. Right? The accounting equation. Assets equal liabilities plus owner's equity. So to isolate owner's equity or capital, assets minus liabilities, the asset book value is 300 minus liabilities of 0 gives us a book value of $300. They each own 1/3, so their book value of their capital account is 100, 100, and 100. For the basis in their capital account, the way we do that, since there's no liabilities here, there's no liabilities in this problem, it's going to be equal at formation to the partner's basis in their capital account. The partner's basis in their partnership interests. It's going to be equal. So let's go ahead and look at the consequences. So we have the three owners, A, B, and C. Again, each of them have no gain or loss. From there, again, we have to apply the partnership rule, the outside basis rule. So it's just going to be carryover basis. A is giving up just land. The land has a basis of $40, so A's basis and his or her partnership interest is 40. B's giving up two assets. Again, carry over the basis. That's going to be the 40 cash and the 25 basis in the machinery. So that's going to be $65. And C is giving up stock with an adjusted basis of 160. So there's their basis and their partnership interests. So we can go ahead and use these bases as a basis in their capital account with respect to the partnership. 40 for A, 65 for B, and 160 for C. All right. So we have to worry now about the holding period. And the reason why holding period matters, remember, is because if the partnership is going to dispose of an asset, if that asset is potentially Section 1231 or capital, makes a difference how long it's been held. For a partner, in general, the partnership interest is considered a capital asset to them. Not 100% of the time, but in general. So if it's held for long term, it's going to be long-term capital gain or long-term capital loss. If it's short-term capital gain, short-term capital loss. So let's start by talking about the partnership because that one's easy. For partnership, everything tax. All items get to tax. Now, cash isn't really taxed because it's cash. There's no difference in terms of gain or loss. But everything tax. So that means that the land, which was acquired several years ago, gets to add on the several years. The machinery, several years ago. The stock, 3 years. You get to add on those periods of time. So the partnership later sells it the next day. Get to add on those periods of time. For the partners, the rule is you get to tax if it's a capital asset that they contribute in their hands or Section 1231 asset. Capital or Section 1231 asset. So let's go through the three. A contributes a capital asset. The land is a capital asset in the hands of A. So that means that A tax on. And because A held the land for several years, the partnership interest is automatically considered long-term because you get to add on those several years. B is giving up two assets, cash and machinery. Now, cash is a fresh start. Machinery, if it was held as business, is going to be a Section 1231 asset. However, there's also Section 1245 recapture because depreciation was taken. So we're just going to say this is split. A split holding period. It's a more advanced issue beyond this video to actually allocate the holding period, but it's a split holding period. In partnership tax land, you can either use fair market value or basis to allocate the holding period. Okay, it's a split holding period. C is contributing stock, which was held in investment, held for 3 years. So this one's also going to be tacking because guess what? Stock is almost always a capital asset. So this is going to be tacking and going to be automatically long term. Other issues to consider in this problem. So, with respect to the machinery has 1245 recapture issue. If B was to sell the machinery, not all of it be 1231. There's also some depreciation recapture to consider. So the question becomes, does that trigger any gain? The answer is no, it doesn't. It does not trigger gain here to B. But what it does is the machinery going forward in the hands of the partnership, that depreciation recapture goes with it. It sticks with it. And that depreciation recapture would actually be allocated to B in the future if the partnership later sells the asset. Which also brings up the issue of all of these assets, the land, the machinery, and the stock, have built-in gains or losses. What do I mean by built-in gain or loss? Take the land, for example. The land, when A contributes it, has a basis of 40, value of 100. So there is a $60 built-in gain. That $60 built-in gain that is inherent in this land if the partnership later sells the land, that $60 gain gets allocated to A, regardless how else gains or losses are allocated. So if they're going to split gains and losses based on profits, losses, right, which are 1/3, normally you take the $60 gain to be 20, 20, 20. But what we're saying is because A contributed when it had that gain, A is going to get that $60. Anything beyond that gets allocated 1/3, 1/3, 1/3, but that portion of gain gets allocated specifically to A. We have another problem that considers that issue, but I want to mention that. Same thing with the other gains and losses that are built in the problem as well. And that concludes this problem.